Okay, let's dive into this fascinating look at the M&A landscape in 2025. If you were paying attention, late last year, you probably heard a lot of talk, a lot of anticipation that 2025 was going to be the big comeback year.
Yeah, for mergers and acquisitions, definitely, after a couple of kind of quiet period.
Right. Maybe things would finally get moving, perhaps really pick up after the U.S. presidential inauguration.
That expectation was certainly widespread. There was definite pent-up demand and, a significant amount of capital just waiting on the sidelines.
Yeah, money held by companies, investors, all eager to put it to work.
It really felt like the stars were aligning for, well, a surge in deal activity.
Right. The stage seemed set. But then the first quarter of 2025 arrived. And the material we're digging into for this deep dive, it highlights a specific data point that tells, well, a slightly different story than that predicted flurry of deals.
Yeah, U.S. announced deal value in Q1 2025 came in at, what was it, $111 billion?
And while, $111 billion sounds like a lot.
It does, but it actually represents a 33% year-over-year decrease compared to the same period in 2024.
Wow, 33% down. So definitely not the big comeback many were forecasting, at least. Not right out of the gate.
Precisely.
So the mission for this deep dive, pulling from the info you've shared, is to understand, why this anticipated surge hasn't quite happened yet. What factors are holding things back? What conditions actually need to be in place for that pent-up demand to break through?
And crucially, where the real opportunities might lie, and the potential pitfalls, too, for you as an investor or just watching the market.
Yeah, what can we learn from this unexpected kind of slow start?
It's really about getting past the headlines, understanding the forces at play beneath the surface.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So based on the material, what's the biggest factor? The thing cited most for companies, for investors, holding off on big deals. What's the main issue?
The core issue, according to the analysis we've seen, it really remains the need for clearer macroeconomic visibility.
Macro visibility.
Yeah, deal making, it inherently involves making forecasts, right, about future performance of the combined company. And right now, there's still, maybe too much uncertainty, too much volatility in the broader economy to make those forecasts with real confidence.
And the sources specifically mention things like potential tariff flip-flops. That sounds disruptive.
It does, and also just the sheer rate of news flow coming from the new U.S. administration, that's contributing to the uncertainty too.
So it sounds like companies are finding it hard to build reliable financial models when basic economic policies feel like they could shift sort of unpredictably.
Yeah, that's the central point here. The thinking is that deal makers, they just need a stable base, a platform to project revenue, costs, market conditions years out.
Right.
And when policies, particularly things like international trade or regulation, are in flux or, subject to sudden changes, those long-term projections become way less reliable. It just introduces this layer of risk that makes those huge commitments harder to justify.
It's almost like trying to plan a long road trip when the weather forecast keeps changing drastically every hour.
That's a good way to put it, yeah. You have a destination, but you're hesitant because you don't trust the map or the forecast.
Right.
And the material makes a really critical distinction here, I think. It's not necessarily that you need a bullish market, like a booming market, for deals to happen. What's needed is a consistent market, even in an environment that includes, say, tariffs or anticipates lower growth, that can still support M&A activity if that environment is stable, if it's predictable.
Consistency is the key. Predictability, not necessarily peak performance.
Exactly. That's what allows deal teams to get the confidence they need to actually move forward.
Okay. And we know the desire is there, right? The sources say there's tons of cash waiting.
Oh, absolutely. The sources really emphasize that. There is a lot of cash on the sidelines, held by corporations, strategic buyers, private equity firms globally. They're actively looking to deploy this capital. Drive growth, achieve synergies, exit investments.
But they're waiting.
They're essentially waiting for the dust to settle, as the source puts it, on the macro and policy front.
Okay, so macro uncertainty is a big cloud. But what about the regulatory side, specifically antitrust? Heading into 2025, there's this strong expectation, wasn't there, that the new administration would be, well, much more relaxed compared to the last one. Has that panned out?
This is where the picture gets really interesting. And the initial theory, the thing driving that optimism about a quick M&A rebound, it kind of intersects with the actual results we're seeing now. A major part of that expected surge was based on anticipating a less stringent antitrust environment compared to the Biden administration.
Right, and under Biden, as the material outlines, the approach was, well, notably stricter.
Definitely. They weren't just focused on the traditional stuff like horizontal deals, mergers between competitors. They also actively challenged vertical deals, companies at different stages of a supply chain merging.
Like the Amazon robot example that's often cited. That was vertical, and it got blocked.
Exactly. And the analysis suggests that particular block might not have happened under, say, earlier administrations, even Democratic ones. It highlights that shift.
And it wasn't just the deal structure, right? The sources mentioned companies facing scrutiny based on past conduct.
Yeah, even if the deal itself didn't have obvious overlaps. The Amgen trying to acquire Horizon Therapeutics example comes up. No direct competition there on current products, but the FTC challenged it based on Amgen's past actions with totally unrelated drugs.
And that highlights a key downside, right? Or a risk under that previous regime, even if the deal eventually settles, like Amgen's did.
Right. But the challenge caused huge delays and a massive cost burden, hundreds of millions in legal fees for the firms involved.
Wow.
That kind of long, costly process, even if the deal closes eventually, it acts as a real deterrent for future M&A.
Okay, so the theory was, Trump administration, clear departure from that stricter approach. Have we seen results confirming that shift?
Yes, there's a pretty significant result that points to a less stringent approach, at least for certain large deals. The material highlights the approval of Capital One's $35.3 billion purchase of Discover Financial Services. That was back in April 2025.
Okay, yeah, I remember that one. Big deal.
Huge deal. And it involves notable overlaps, like in subprime credit cards, and it creates the 8th largest bank in the U.S. The consensus view pretty much is that this type of deal was highly likely to have faced really strong opposition from the previous administration.
So its approval is seen as confirmation. A real shift in regulatory posture, especially for financial services consolidation.
Widely interpreted that way, yes. It confirms a material shift.
So some major deals getting through that likely wouldn't have before, that fits the theory. But the material also adds a caveat, right? It's not like the 80s deregulation all over again.
Absolutely not. No, it's not a free-for-all. The source gives the example of HPE trying to buy Juniper.
Okay.
That was a purely horizontal deal, direct competitors, and it was blocked. Described as a textbook anti-competitive deal.
Right. So deals that clearly reduce direct competition are still likely to get blocked.
Seems so. They'll still face scrutiny.
And from an investor perspective, like merger arbitrage folks, the source suggests it's actually a good thing that not every deal gets approved. Why is that?
Well, the thinking there is that selective blocking helps maintain positive spreads. If investors were totally certain that every single announced deal would close without any regulatory hiccups, the potential return that spread between the target stock price and the deal price, it would shrink dramatically. Or just disappear.
Ah, okay. Makes sense.
So a process where genuinely anti-competitive deals are still challenged, but the less problematic ones can proceed, it maintains that necessary level of risk, and that provides the opportunity for those arbitrage investors.
Got it. And the new FTC head's stated strategy seems to fit this, like block the bad ones, move quickly on the okay ones.
Seems that way. The source notes he indicated clearly anti-competitive deals likely blocked, non-problematic ones reviewed and decided quickly. That's a significant shift in practice compared to the last 4 years, aiming for more predictability within the regulatory process itself, even if the wider economy is still, unpredictable.
Right. Speaking of macro factors holding things back, the material uses what's happening in the private markets to kind of back up the point that macro uncertainty, not just antitrust, is the main barrier. How do private deals show that?
Well, the thinking is that private deals are often just easier to negotiate and price, because the target company's board doesn't have to constantly watch and react to a volatile public stock price when they're trying to agree on a value.
Right. Public company boards feel pressure based on recent stock highs or whatever.
Exactly. When the stock market's choppy, agreeing on that fixed price is really tough. In private deals, the negotiation can focus more purely on the underlying business fundamentals. Less noise.
So if bigger private deals are happening, it suggests that when you strip out that public market volatility factor, the underlying appetite, the ability to get deals done, it's still there.
Precisely. And the results highlighted in the material show that significant private deals have been transacting recently, even while public M&A slowed down. They point to Alphabet buying Wiz Cybersecurity for $32 billion.
Wow.
Constellation acquiring Calpine Energy for $16.4 billion. WorldPay acquiring a unit from Global Payments for $24 billion.
Those are huge private deals. So the strategy sometimes might just be to avoid the public markets altogether, to get more certainty.
That seems to be one outcome in this environment, yeah. And this dynamic's particularly clear in what they call the upper middle market.
Upper middle market,
Yep.
companies with $100 million plus EBITDA.
Right. Earnings before interest, taxes, depreciation, amortization. So pretty big companies. The theory here is that these large borrowers needing maybe multi-billion-dollar debt packages for acquisitions, they historically relied mainly on the broadly syndicated loan market, the BSL market.
The public loan market, basically.
Yeah, large corporate loans packaged and sold to banks, investors. But now, because there's been this huge flood of capital into the biggest private credit funds, these companies have a choice. They can get M&A financing publicly via BSL or privately through these massive direct lenders.
That competition must really change the game for financing big deals.
It absolutely does. Gives borrowers leverage. Compare that to smaller deals. Those companies often only have the private market option.
So different dynamics at play.
Yeah.
And what's the result of that difference? The source mentioned something about yield pickup.
Right. The yield pickup of core middle market direct loans compared to broadly syndicated loans.
Okay, break that down for us. Yield pickup is?
It's basically the extra interest rate, the extra yield an investor gets for lending in that private core middle market compared to lending in the public BSL market.
Right.
Historically, that difference, that premium, was typically around 100 to 125 basis points, so 1% to 1.25%. According to the source, as of December 2024, that pickup had jumped significantly, up to 245 basis points.
2.45%. That's a big jump.
It is. And that wider spread is a direct result of those different financing dynamics available to larger versus smaller companies. It really underscores the unique forces in different parts of the debt market supporting M&A right now.
Okay. That makes the concrete result much clearer, that risk and liquidity gap is widening. Let's talk private equity specifically. PE firms sitting on record cash, dry powder, but deal activity's been kind of slow. What's the theory there, and what strategies will they use to deploy it?
The main theory for the recent PE slowdown really centers on a dearth of exits.
Can't sell stuff easily.
Exactly. PE funds are big sellers, not just buyers. They haven't been able to sell their portfolio companies at the prices they think they're worth. They've been holding out, waiting for better conditions or higher prices.
So if they can't sell at the prices they want, that limits returning capital to their own investors, the LPs, and slows down new investments.
Precisely. As a direct result of this slow exit pace, private firms globally are sitting on what the sources call record levels of deployable capital.
That dry powder number.
Estimated to be well over $1 trillion. That needs to be invested.
Over $1 trillion just waiting. That's an incredible amount of potential activity. Is there pressure building on the PE firms to get that money working?
Oh, absolutely. There's considerable pressure from the limited partners, the pension funds, endowments, sovereign wealth funds who invested in the funds, pushing the general partners, the fund managers, to do deals and put their capital to work. LPs committed that capital expecting returns, right? And that trillion plus is essentially just sitting there.
Okay, so pressure's on, huge amount of cash ready.
Uh-huh.
What are the expected strategies for deploying it, according to the material?
They see a few key paths. One is an expected rise in PE sponsor to PE sponsor deals.
One PE firm selling to another.
Right. The thinking is, since both sides really understand the market, the valuation challenges, they might be better able to bridge that price gap and agree on terms.
Makes sense. What else?
Another avenue is deals involving family business owners selling, often to PE for the first time. Strategic buyers, other corporations will still be active, of course. And finally, public to private takeouts. PE firm buys a public company, takes it private, especially if public market values look attractive for LBOs.
Okay. Let's shift now to specific sectors and geographies. Are there certain areas where deals might pick up sooner or are already showing more life, maybe less tied to that big macro picture?
The material definitely highlights two sectors where they expect more activity: healthcare and technology.
Right. Healthcare first. What's the main strategy or theory driving M&A there?
Well, healthcare companies, especially big pharma, they've been pretty cash rich. And the sources point out M&A here is often driven by cost efficiencies and managing expiring drug patents, not just growth. Pfizer is a key example. Generated, $35 billion from COVID vaccines? But now facing major drugs going off patent.
So they need to refill the pipeline.
Exactly. Their strategy under the previous administration was buying smaller single-drug biotechs. Those were generally seen as less controversial deals, easier to get through regulators.
So they have the cash, the strategic need. What strategy or results are expected now under the new administration?
The anticipation under Trump is for potentially larger-scale healthcare consolidation.
Bigger deals.
Could be. Maybe large pharma buying mid-sized global distribution companies. Also, healthcare services deals, insurance, hospitals. Those faced political heat under Biden. They're expected to be more accepted now, or at least find ways to get approved, maybe with some negotiated remedies.
Interesting. Okay, what about technology? Tech M&A is usually more about growth, innovation, right?
That's typically the main strategy, yeah. The sources mention the ongoing debate around big tech, Facebook, Google, Amazon. Will they be able to do really big acquisitions under the new administration? The analysis is a bit skeptical that the absolute biggest players will do lots of huge deals, but they see considerable opportunity beyond those giants.
Where exactly in tech are they pointing?
They highlight that even outside the, Magnificent Seven type names, there are a number of USD 100 billion plus tech companies out there that are eager to do M&A to drive their own growth, their competitive position.
That suggests a lot of firepower waiting in that next tier down.
It does. And as a result, we're seeing strategically important deals like IBM buying HashiCorp. That's critical for IBM's strategy, its growth, given their relatively low organic growth otherwise.
Right.
The sources also briefly touch on Europe's tech sector, suggesting there are some stale companies there, gaming, travel, publishing, that could really benefit from the strategy of deploying AI to boost innovation efficiency. That could spark deals there, too.
Okay, healthcare tech look promising.
Yeah.
What about outside the U.S.? The sources call the U.S. the epicenter, rightly so, but what's the picture elsewhere, like Europe?
Europe's a really interesting case. The material mentions the theory from the Draghi report that European companies lack competitiveness compared to global peers, partly due to things like overregulation. And you have leaders like Ursula von der Leyen saying Europe needs its own champions, companies that can compete globally, like U.S. or Asian giants. Achieving that, the thinking goes, likely requires a strategy of loosening antitrust laws within Europe, even if that means allowing deals that might have raised eyebrows before.
So the potential strategy for European growth involves regulatory tweaks to allow consolidation, create bigger players. What results are they seeing or expecting?
They're seeing some movement. Financial institutions, especially Italian banks, starting to respond to calls for consolidation. UniCredit, for example, has the strategy of expanding into Germany, aiming to be a pan-European banking champion. The challenge, though, is many banks want to buy, not be bought.
Right. Everyone wants to be the consolidator.
Exactly. Banks are also focused on improving their ROE return on equity as a strategy to look more attractive, maybe as buyers or targets, and considering things like SRTs, significant risk transfers to manage capital. Consolidation also makes sense in European pharma. Several large companies could accelerate growth via M&A.
Okay. And Japan. Sources noted it was one of the few places with more M&A in 2024. What's driving that?
The core theory there is ongoing corporate reforms, making companies more shareholder-friendly, changing governance, management attitudes towards capital, making them more open to deals.
And have we seen concrete results from that? More deal flow?
Yes, definitely attracting more interest, especially from private equity. PE sees opportunities in companies that might have been resistant before. A specific result cited is Fujisoft selling to KKR. That's a major PE deal, really underscores the trend.
That's a big result, yeah. Showing those reforms are attracting global PE money.
It is. Now, the sources do mention some potential downsides or risks, pointing to negative outcomes or shareholder fights involving names like Nissan's Seven & I Holdings.
Right, not always smooth sailing.
No, but overall, the outlook for M&A in Japan, driven by these structural changes, still looks positive beyond those specific bumps.
Okay, finally, let's touch on a specific strategy that seems to be rising. Unsolicited acquisitions. Hostile takeovers. Sources noted a notable increase. Why now?
Well, the theory behind more unsolicited or hostile M&A is it often happens when there's significant pent-up demand from buyers. They're really eager, but the target board is reluctant or just not engaging.
So the buyer bypasses the board, goes straight to shareholders.
Exactly, tries to force a transaction.
So it's a strategy born of frustration, maybe? Maybe sellers' price expectations are still too high, linking back to those slow PE exits.
That's likely a factor, yeah. It's seen as a high-risk, high-reward strategy, both for the bidder and for investors betting on the deal closing.
High risk for investors. What are the downsides there?
Several risks mentioned. Unlike a friendly deal with a signed agreement, there's no initial commitment from the target. High chance of counterbidders emerging, driving up the price, or complicating things.
Okay.
And critically, the deal can fall through at any point. Target board fights it off, financing collapses, regulators step in unexpectedly. Lots of ways it can fail.
Okay, lots of potential pitfalls. But the sources also suggest this environment creates a particularly attractive opportunity for merger arb investors right now. Why is that the result?
Because that inherent risk in unsolicited bids is higher. The potential reward, the spread between the target's current stock price and the offer price, it tends to be wider than in friendly deals.
Bigger potential profit for taking on more risk.
Exactly. Offers a larger potential margin for those willing to take the chance. The material specifically notes this is true, especially in the leveraged buyout, LBO space, where the complexity in financing add another layer of risk and potentially wider spreads.
Okay, so bringing this all together, the material paints this picture of a market where the underlying desire for deals is strong. Some regulatory hurdles might be easing for certain deals, and there's definite activity brewing in sectors like healthcare, tech, and regions like Europe and Japan.
That's a fair summary, yeah. Many of the conditions seem to be falling into place. Potentially less tricky regulation for some deals. That huge pent-up demand from corporates and sponsors, growing strategic appetite.
But the key unlock, the single biggest thing still holding things back, needed for that surge to really happen, it remains that more predictable macroeconomic environment.
Exactly. Companies, financial sponsors, they're sitting on so much capital. That money is effectively burning a hole in their pockets, as the saying goes. But they're waiting for that layer of macro and policy consistency to get the confidence needed to pull the trigger on the big ones.
And the analysis suggests this pent-up demand, that trillion plus in dry powder, the strategic needs.
Yeah.
They're significant forces. The sources believe it will happen at some point.
The underlying pressure, the drivers for M&A, they're definitely there. It really feels like a matter of when that external environment gives the green light, provides that stability.
So, based on everything we've unpacked here, all these complex factors influencing M&A, global volatility, tariffs, presidential approaches to antitrust, private market dynamics, PE pressure, sector opportunities, what does this tell you about just how interconnected everything is? How does uncertainty, whether it's geopolitics or policy shifts, ripple through and hit even these really strategic corporate decisions all around the world? Something for you to think about as you watch the markets.